particularly after the announcement that we are headed back to a global QE3 and an insular national QE3, is concern over how the ISDA will define the credit event about to take place, the greater haircut of the Greek debt. Because it's an election year, and because it's too much to think of that you would call into service the default swaps, which can't and are not financed to service. You have to go through another bank rescue. Eventually, it's going to have to happen, because eventually this can kicking down the road is not going to witness a major economic recovery in Europe that it finances the government's ability to meet their deficit responsibilities.
Well, this bank rescue,
it's complex crap, but let me tell you, it's real.
Well, this bank rescue couldn't possibly happen during 2012.
Well, put it this way, I mean, if it had to happen, it would. But every single thing possible would be done not to let it happen, such as the financing of the rollovers, which has already taken place. The Fed has announced the swaps, and the IMF has come out with their emergency line, the combination of which equals the amount of the rollover for the first quarter without any more financing required. As you go out into the second quarter, it's a different story.
Well, let's talk about general equities for a moment and
Sure.
stocks.
Sure. General equities and stocks, the IBMs of the world, the Netflix of the world,
Google,
the NASDAQ
Facebook
stocks of the world, not the gold shares, okay,
Mhm.
are strongly supported by the return to QE. So why aren't they through the roof today? Because a credit event is about to take place.
All right. Now we're talking to not only investors in precious metals, gold and silver and what have you, but we're talking to investors across the board with a variety of things to invest in. Stocks like Netflix and Google, Microsoft, whatever. And then we've got gold in the picture, and we want to make some money right now. Or maybe where are we to go?
Well, you have to understand the critical nature of today, the time we're talking to our listeners and between ourselves. The return to quantitative easing is an event which impacts liquidity. Historically, always and into the future, the main motivator of the general equities markets, the Netflix and the Googles of the world, is liquidity. The reason we came out of the bear market in 2009 was quantitative easing. The reason we've been able to hold the general equity levels at a relatively high level, meaning circling around that 1,200 on the Dow, is without any question liquidity. The grease of the wheels of the equity markets has always been not necessarily earnings per share, not necessarily valuations historically, but rather the presence of liquidity or lack of liquidity in the market at any given time. The advent of quantitative easing is good for gold. It is good for the general equities markets. It is negative for the dollar and positive for other than dollar items. However, QE is not a solution to anything. Quantitative easing, or the increasing of liquidity, or the actual creation of money out of thin air, is the bubble-making mechanism that you saw in real estate. It's a bubble-making mechanism that you see in asset values. It puts money into the hands of people who have to make investment decisions and will make them generally along the lines of what they're most familiar with and what they're most used to dealing in. Today, we are standing on the threshold of a credit event. That is the determination of how the Greek debt will be handled amongst the Euro nations. The people who will define what that credit event is is the International Swaps and Derivative Association. The International Swaps and Derivative Association will determine whether a credit event is a default, a sovereign default, or not. In the most practical sense, we're in an election year. In the most practical sense, and recognizing that 5 of the U.S. major banks hold 97% of the obligations on credit default swaps, that is, that they have guaranteed the buyer of this instrument against the default of an instrument, primarily euro debt. So the credit default swap is actually an insurance policy that brokerage firms issue. And there is an organization which oversees that, basically writes the master agreements, came into existence in the early 1990s. It was the body that determined that Goldman and Deutsche Bank and all those should be paid out on the shorted mortgage-backed issues. It's the body that will determine whether or not a sovereign nation has defaulted. So as we kick the can forward, we'll have to, for practical reasons, 97% of this insurance policy granted by 5 of the U.S. largest banks, this credit event about to happen, the 30% or approximately, which got a 3 in front of it, where the euro, where it will be determined that that Greece's debt will pay out, is either going to be determined to be a credit default or not a credit default. Excuse me. Yes, a credit default or not a credit default by the International Swaps and Derivative Association. The International Swaps and Derivative Association is primarily made up of representatives of the banks that deal in these items. And logic would say that their determination would be that no matter what happens to the Greek debt, it's not a default, because if they decided otherwise, they'd have to pay out. What I'm doing for you is giving you a case of why more liquidity, not less liquidity, is forthcoming. Why we've already set up and why the Fed last week announced the return to QE. While even before that, in late December, the Fed provided over $500 billion worth of swaps to the ECB, who in turn lent that money to the member banks, who in turn used that money to buy euro debt, which is global quantitative easing. The bottom line is that what's taking place is as good for equities as it is good for gold investments, as it is not that good for the dollar. So it's very complex. We've made this world so complex that simplicity no longer exists, and casino is everywhere. Bottom line of this analysis: both equity markets and equities of gold and gold itself should rise. Bottom line of this analysis: 80 to 82 is the top on the dollar for fundamental reasons. The real importance of this analysis is that you cannot kick this can of credit default swaps much further down the road, because there is a point. The point is zero. How in the world would the International Swaps and Derivative Association say that Greece was not a default if they paid back 10% of what they owed, or nothing of what they owed? And the 5 major banks holding these had to insure the debt. And in going to insure the debt, compare it to the capital of the banks. They don't have it. It's another paper game we've created to enrich the banking industry and to put the entire world into potential jeopardy.
So if we like the 2 previous bubbles, we're really going to love this one until
this bubbles, you're going to love this. You're going to enjoy it no end.
For at least a year or 2, maybe.
Absolutely.
And then watch out.
Yeah.
So wrapping up, what is the best way to position ourselves as investors against this right now?
Well, it's a point. You know that I'm a firm believer in gold as a currency. I tend to be a conservative, but the truth of the matter is that what's happening now, what your airwaves are talking about, general situations in general equities, shouldn't be ignored.
Are you investing in general equities, Jim?
Special situations, always. Things that I happen to like for one reason or another, I'd always have some interest in.
Are these anything you ever talk about, or is this between you and you?
This is between me and me as a trader.
Okay, fair enough. I had the pleasure of meeting with David Duval in Vancouver at the recent resource conference up there, and there was a lot of exuberance in the room, and it was over-attended. I would say the investing public, if you want to get a feel from the talk of the 2 days I was there, are very charged up about the precious metal sector for the coming few years.
And it would perform better if general equities are going in the same direction up.
Interesting.
Not falling apart and going down.
Do you think there's going to be as much liquidity in gold stocks as there's going to be in general equities?
No. The entire capitalization of the gold shares isn't equal to one major entity, IBM. So the idea that you would ever get more liquidity in anything related to gold is false. You might get price violence, but you're not going to get liquidity.
And let's also talk about recent happenings with the company you're president of, Tanzania Royalty Exploration Corporation.
Well, we've had some extremely good drill results, and our hope and our focus is on continuing these two new discoveries we've made at Lagunya and at the Buck Reef. We have additional 43-101s coming online. We're in various applications for additional mining licenses. It's a period of major growth for us, and I think it's going to please all of our stockholders.
Well, after pulling back somewhat in recent months, the stock has performed nicely over the last 6 weeks or so.
It has, and that in many situations, not just ours, because if you look around and take a look at comparative companies run by excellent people, but with excellent assets, they experience the same thing. It was a major play by certain hedge funds, which I think has played itself out by having overdone it.
Well, Jim,
you just take a look at McEwen's company as being a clear example of that.
You want to elaborate on that a little bit more?
Well, I mean, if you take a look at us and U.S. Gold and ran the two charts together, there's very little difference on the down. McEwen is extraordinarily well known in the gold business with extraordinary successes and good assets and activity right now. He suffered exactly as we suffered. We suffered exactly as he did. It was patterns that were so alike that they had to be drawn by the same people, not by others. These things don't happen by chance. Technical analysis may be considered by most to be the finest way to know what the price of a situation is going to do, but in truth, it's also something which is easily painted and manipulated to make people skin people. So
it is personal.
Yeah.
Jim, it's always a pleasure to speak with you. Thanks so much for this fantastic interview. I look forward to
you look and have the listeners. Please look up the ISDA. Go to their Google or whatever crawler they use, and get a full definition of the International Swaps and Derivative Association.
Well, it's ISDA.org. That's the website.
Go and learn about it.
Thank you, Jim. I appreciate your being with us here on the program as always today.
Well, I enjoy it because what we talked about today, the ISDA is more powerful than any government in terms of the financial decision they're going to be called upon to make probably this week.
Thank you, Jim.
And that's my unedited raw interview with Jim Sinclair over the telephone today. I'm required to note that Jim Sinclair is the president of Tanzanian Royalty Exploration Corporation, trading on the New York Stock Exchange under the symbol TRX. We spoke of the company in the interview, as we always do, and Tanzanian Royalty is a paid sponsor of the Ellis Martin Report. Thanks for listening.